Hey traders, welcome back to the channel. Today, we read diving deep into one of the most popular and versatile tools in a trader's arsenal, the MACD indicator. If you've ever stared at a chart and felt lost, wondering when to buy or sell, then this video is for you. We're going to break down what the MACD is, how it works, and most importantly, how you can use it to spot potentially profitable trading opportunities. By the end of this video, you lines have a solid understanding of how to read its signals and integrate it into your own trading strategy. So grab a notepad, and let's get started. First things first, what does MACD stand for? It's the Moving Average Convergence Divergence Indicator. That sounds like a mouthful, but don't worry, the concept is simpler than it sounds. At its core, the MACD is a trend-following momentum indicator that shows the relationship between two moving averages of a security's price. It was developed by Gerald Apple in the late 1970s and has stood the test of time, remaining a favorite among traders of all levels. So, how is it constructed? The MACD is made up of three key components. First, we have the MACD line itself. This is calculated by subtracting the 26-period exponential moving average, or EMA, from the 12-period EMA. Think of the 12-period EMA as the fast-moving average and the 26-period EMA as the slow one. When the fast EMA pulls away from the slow EMA, it indicates that momentum is picking up. The second component is the signal line. This is a 9-period EMA of the MACD line. Because it's an average of the MACD line, it moves more slowly and acts as a trigger for buy and sell signals. When the MACD line crosses above or below this signal line, it can be a sign that a change in momentum is happening. The third and final component is the histogram. This is the part that often looks like a bar chart on your screen. The histogram simply plots the distance between the MACD line and the signal line. When the MACD is above the signal line, the histogram is positive and appears above the zero line. When the MACD is below the signal line, the histogram is negative and appears below it. The height of the bars shows how strong the momentum is. Taller bars mean stronger momentum, while shorter bars suggest momentum is fading. Now that we know the parts, let's talk about the most common way to use the MACD crossovers. The first type is the signal line crossover. This is the most frequent signal the MACD generates. A bullish crossover occurs when the MACD line crosses above the signal line. This is often interpreted as a buy signal, suggesting that upward momentum is increasing. Conversely, a bearish crossover happens when the MACD line crosses below the signal line. This is seen as a sell signal, indicating that downward momentum is building. It's a simple yet effective way to get a quick read on potential shifts in price direction. The second type of crossover is the zero line crossover. Remember the histogram. The line it oscillates around is the zero line. When the MACD line crosses above the zero line, it means the 12-period EMA has crossed above the 26-period EMA. This is a broader confirmation of an uptrend. It tells us that short-term momentum is now stronger than long-term momentum, signaling a potential shift to a bullish phase. On the flip side, when the MACD line crosses below the zero line, it suggests a potential shift to a bearish phase, as short-term momentum has weakened relative to the long term. These signals are generally slower than signal line crossovers, but they can be more reliable in confirming a major trend change. Alright, let's move on to a more advanced and powerful technique, finding divergence. Divergence is when the price of an asset is moving in the opposite direction of the MACD indicator. This can be a powerful warning that the current trend might be running out of steam and a reversal could be on the horizon. There are two main types of divergence. The first is bullish divergence. This occurs when the price makes a new lower low, but the MACD makes a higher low. Think about that for a second. The price is falling, hitting new lows, which looks very bearish. But underneath the surface, the MACD is showing that the downward momentum is actually weakening. This discrepancy suggests that the sellers are losing control, and the price might be getting ready to reverse and head upwards. Spotting this can give you a heads up to look for a potential buying opportunity. The second type is bearish divergence. This is the exact opposite. It happens when the price makes a new higher high, but the MACD makes a lower high. The price chart looks strong, pushing to new heights, but the MACD is telling a different story. It's showing that the upward momentum is fading. The buyers are getting exhausted. This is a warning sign that the uptrend could be nearing its end, and a reversal to the downside might be coming. It's a signal to be cautious and perhaps consider taking profits or looking for a short entry. Divergence is not a foolproof signal, but it's one of the most respected signals the MACD provides. Now, a very important point. No indicator is a magic crystal ball. The MACD is a fantastic tool, but it has its limitations. It's a lagging indicator, meaning it's based on past price data. This means it will always be a step behind the actual price. In very choppy, sideways markets, the MACD can generate a lot of false signals, or whipsaws, leading to losing trades if you rely on it exclusively. This is why it's crucial to never use the MACD in isolation. So, how do we make it more effective? By combining it with other tools and analysis techniques. For example, you can use the MACD for signals, but confirm them with price action analysis. Look for your MACD crossover to happen near a key support or resistance level. A bullish crossover at a strong support level is a much more powerful signal than one that happens in the middle of nowhere. Similarly, a bearish divergence that forms as the price hits a major resistance level is a high probability setup. You can also combine the MACD with other indicators, like the Relative Strength Index, or RSI. The RSI measures the speed and change of price movements, helping to identify overbought or oversold conditions. If you see a bullish MACD crossover while the RSI is moving out of oversold territory, that's a strong confluence of signals telling you the same story. Combining tools helps filter out the noise and improves the quality of your trading signals. Let's quickly recap what we've covered. The MACD consists of the MACD line, the signal line, and the histogram. We can use it to spot trading signals through signal line crossovers and zero line crossovers. An even more powerful technique is looking for bullish and bearish divergence, which can signal potential trend reversals. And finally, the golden rule: always use the MACD as part of a comprehensive trading plan, combining it with price action and other indicators for confirmation. Mastering the MACD, like any trading tool, takes practice. Open up your charting platform, add the MACD indicator with its standard settings 12, 26, and 9 and just watch it. Go back in time on your favorite stocks or assets and see how the MACD behave during major price moves. Identify the crossovers and divergences. This practice, known as backtesting, will build your confidence and help you develop an intuitive feel for how the indicator works in real time. Thank you so much for watching. I hope this detailed breakdown of the MACD indicator helps you become a more informed and confident trader. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe to the channel and hit that notification bell so you won't miss our future content. We have more deep dives into trading tools and strategies coming soon. If you have any questions, drop them in the comments below. Happy trading, and I'll see you in the next video.